November's coming right around the corner. There's a lot of hype out there on who's going to win. Are you going to change your investment strategy or philosophy? Should you? That's the bigger question. Stick around and we will help answer that. Welcome to the show, everyone. Show's called Your Money, Your Wealth. My name's Joe Anderson, president here at Pure Financial Advisor. And this show, of course, is not the show without the big man hanging out in Hawaii. There's Big Al Clopine, looking dapper as ever in his living room or wherever the heck he is.
Aloha from Hawaii, Joe.
Zoom. Who would have thought that Zoom can just bring everyone together? Hey, you know, you're looking at certain things when it comes to your investments, and I know that you are. Should you make changes? Should you move quickly in and out of the overall markets depending on who gets elected? Should you do that? That's today's Financial Focus, folks. Here's the stats, which is amazing to me. 93% of investors believe that the presidential election will have an impact on the stock market. 93, almost all of us believe this, that no matter who gets in, right? If it's blue or if it's red, we believe that will have some impact on the overall markets. Almost another 100%, 84% says whoever gets elected will change their investing habits. Should you do that? Is that the right decision? When everyone is doing it, do you want to follow the herd or do you want to do something different? Well, let's break it down. Let's bring the big man in from Hawaii, Big Al Clopine.
Hey, it's good to be here from Hawaii, and we've got presidential election year. So we're going to try to break down what's going to happen in the market by going over historical performance to start off, and then we're going to look at Republicans versus Democrats, which is better for the market. The results may surprise you. What this all means to you, of course, and then most importantly, how to practice sound investment principles during election years, and for that matter, during all years. So, Joe, it's a topic that it's on everyone's mind in terms of what happens to the market in an election year, particularly this particular cycle when it's a little bit divisive in terms of the candidates. So, I think it's a well-timed show to just talk about what's happened in history.
Well, emotions in investing are never a very good combination. But when you put a presidential election, and I don't know if this year, I think every presidential election there's very high emotions. But it seems this year's a little bit more spicy than others. And when people get their emotions involved, that's when we make potentially the wrong investment decisions. Please vote for the person that you want to vote for. But if you're anticipating a market reaction because of the person that you're voting for, you might be a little bit surprised in the overall outcome. A lot of you are thinking about switching your investment allocation depending on the election, or maybe changing your investment habits altogether. By making those moves and doing the research, you might be surprised that you might not be any better off or potentially a lot worse. I mean, look at the research that people are doing in regards to, all right, well, if the current president stays president, if the Democrats win, or if there's a sweep or whatever, it really doesn't matter, Al, to be honest. I mean, I'm going to let the cat out of the bag here. It doesn't necessarily matter.
Yeah, let's go over some of the stats so that people kind of have an understanding. Let's start with what happens during the first few years of a new president or a presidential term. Interestingly enough, and this is Republicans and Democrats combined together, and they're pretty similar. The first and second year are not as good as the third and fourth year. And you might say, well, maybe that's because the president's had a time to put their policies into play. Maybe so, maybe not. There's a lot of things going on in the market besides who's president. But so just realize that the first couple of years are generally not as good as the second 2 years. And then I think, Joe, most interesting is, what if a Democrat wins? What if a Republican wins? What's the best combo? It's not like we've had hundreds and hundreds of presidents. So this is just based on history. So, it could be different going forward. A Republican president versus a Democratic president has done better in the first 2 years, but about the same after 4 years. Not much difference. And then you look at Republican president with a sweep in Congress and the House. That does even better. But the best combination, at least so far in history, is a Democratic president with a divided Congress. So, and again, it's not like we have a lot of data here. We've had, 45, 46 presidents. So this is what we have to work with.
It's funny because on average, it's about 8 to 10%, or 9 to 10%. Republican president, first year, all right, and then it ends off just about the same, 8.6. Democratic president, 8.6. Republican sweep, 8.6. I mean, so some people think that there's going to be these huge dips and swings, and the answer is yes, that will happen in the short term because the market hates uncertainty. And so when there's a presidential election, as soon as it comes up, and if they're very even, right, you're going to see the markets move frantically. And this year is going to be a little bit interesting, just the fact that we're probably not going to know who the president is for quite some time, and we're going to see a lot more volatility. But when things even out over the long term, you're going to see it kind of, I mean, it's funny. I mean, you can't make these numbers up. And then if you just take a look since 1981, who's in office? Is it, Reaganomics? Okay, well, Reagan did pretty good, but then Bush didn't do very well. Obama did okay. Clinton did well. So it doesn't necessarily matter who's the commander in chief. There's so many other players in the game too, which I think people kind of forget about potentially.
Yeah, no question. And looking at that chart, George W. Bush actually did not fare very well. But he had the unfortunate timing of having the dot-com bust, the 9/11, and the Great Recession, which were largely things out of his control. So, like I said, the market is not just about who's the president. It's a lot more than that.
This is also interesting, is like there's recency bias with just about everything, right? And this is looking at all presidential years. The market has averaged right around 11%, okay? Stocks have done 11%, bonds have done 5%. And if I'm looking at the market, if the market dips below that long-term average, well, guess what? A new president is elected or a new party is elected. If the incumbent president is beating the overall averages, well, in history, they tend to stay in office. So it's kind of interesting. If things are going well, hey, let's not rock the boat. If things are not necessarily doing well, let's get a new boat.
Yeah, and I think that's pretty logical because it's like the economy is certainly a big factor in what president that you elect. And when things are going well, people like to keep their jobs, they like to support their family, they like to live their lifestyle, they like to save for retirement. So all these things, like you say, why rock the boat?
I guess, the point of this show is really, to give you information and education about history. We have no idea what's going to happen in the overall future. But just be careful if you're anticipating a certain outcome because a certain president is going to win. Don't do anything rash is basically the message. You want to make sure that you have a sound investment strategy and you've got to ignore the hype. Look at that. Brian Perry's book just came out of nowhere. Ignore the hype, folks. We're giving this book away once again this week. Brian Perry, he's a CFA, Chartered Financial Analyst, Director of Research at Peer Financial Advisor, wrote this great book. There's a lot of hype, there's a lot of noise, there's a lot of information that's coming to us all directions, right? Right now, you got to ignore a lot of the hype when it comes to your investment strategy, right? It doesn't matter who's in office in most cases. If you have a sound investment strategy over the long term, you're going to be just fine. Don't take it from me, take it from the book. All you got to do is go to yourmoneyyourwealth.com, click on that special offer, and we will send you this hard copy for free. Hey, welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson and Alan Clopine hanging out here talking what the heck should we do with our money in these crazy election times. We got Brian Perry coming up. Don't miss Brian Perry. We're going to talk about what is a sound investment strategy during, I guess, fairly turbulent times. But first, let's go to the true-false question.
Since 1984, the S&P 500 has correctly predicted the outcome of every U.S. presidential election based upon its price movements in the last 3 months leading up to the election. And interestingly enough, that is a true statement. So what this is telling us, at least since 84.
But is this a prediction, or is this just a happenstance?
It could be either, right? But it's. I think, if you look at statistics, there's not enough data to really say this is a trend. But it's interesting. So if you look at since 1984, if the market is up in the last 3 months before the election, the party in power, either the incumbent or the replacing president wins. If it's down, then the other party wins. So that's what's happened recently.
So 3 months, so we're into it. We'll just get to see what happens. To the election or to the end of the, I suppose to the election date, huh? So
to the election day.
Interesting. That's what crack research team came up with that?
I don't know. I think that was our producer that helped us on that one.
Well, let's get into some real information, right? Let's get Brian Perry to join us. He's a CFA. He's the director of research. He's also the executive vice president of a firm called Pure Financial Advisors. Brian Perry, how are you doing?
Awesome to be here, thanks.
Hey, interesting times. This time it's different. I'm sure that you've never heard that before. But emotions are high. And we were talking earlier in the show is emotions and investing don't necessarily mix. And it's not necessarily don't vote for the person you want to vote for. Please get out there and vote. But when you start looking at, all right, hey, if this president's going to get in, should I do something different with my overall investments? What's the advice? What should be on the top of mind of people?
Yeah, I would quote Jack Bogle, the founder of the Vanguard and index funds, and he said, don't do something, just stand there. Most of the time, the best thing to do is nothing, right? But again, you can step back to investment fundamentals, take a look at your overall portfolio and see if you're properly allocated. But is this time really going to be different? I don't know.
Who knows, right? I mean, we're not here to say vote one way or another. We just want to make sure that people are making the right sound decisions with their investments because, all things happen in life. And so when bigger things happen, we might switch or shift sharply where it could hurt us versus in our minds, we're trying to help ourselves.
Yeah, of course, and it's human nature, right? I mean, people are passionate about this. They have strong feelings one way or another. But the reality is, we've had control of the government by both parties, right? This is not the first election of our lifetimes. Hopefully it won't be the last, right? Things change. We've had Democratic control of the Senate. We've had Republican control of the Senate. And the economy, markets have persevered. And markets are always going to find something to focus on. 6 months ago, 3 months ago, it was COVID, right? If you think back to the beginning of the year, it was trade wars with China. Now it's the election. Come December or January, whenever we know the outcome of the election, it'll be something else.
I want to give our viewers some juice here, right? Because this is what people want to know. This is what people are doing and doing all the research. Okay, Trump gets reelected. Where should people invest? And I mean, just hypothetically, right? I know they should be globally diversified, but people are thinking, hey, if Trump gets elected, I should shift my portfolio this way. If Biden gets elected, I should shift my portfolio this way. I think you and I both agree that they probably shouldn't do any of that. But what are people hearing? What should if people hear things, it sounds really logical, so they potentially act on it.
Well, what people are hearing is that Trump has been good for the market, and there's a prevailing kind of sentiment that, Republicans are better for the economy or they're more pro-business. So if Trump gets elected, stay invested in stocks, right? We saw what happened after he was elected last time. The market rallied pretty significantly. We're up about 60% on the S&P 500 since Trump came into office. And then the prevailing wisdom or sentiment a lot of times is, Democrats are bad for business kind of thing. Biden would get in, he would crush the business community, raise taxes, and so on. And so you better get out, maybe move more to bonds and cash. The reality and historical precedent is very different than that. But a lot of times that's what you hear from people is Republicans would be good for the stock market, Democrats would be bad for the stock market.
And why is that? When you look at history, the market is the market. The market is almost across the board. If a Democrat's in office or if a Republican's in office, it's almost identical for the long-term perspective.
Yeah. I think a lot of it comes down to kind of the perception of the party, right? That the Republicans are sometimes perceived as lower tax, less regulation, which those two things are seen as being pro-economic growth or pro-business, whereas Democrats sometimes have more of an eye towards societal goods, maybe a little bit more business regulation, maybe slightly higher taxes on some in order to pay for some of the social programs. And so that's seen as more business on-friendly. But again, the reality is we've had long stretches of decades and decades on end where the Democrats controlled Senate. We had many years of Democrats in the White House, and the economy and markets did just fine. I mean, back under President Obama, right? I mean, people have different views on how he ran the country and stuff, but if you just look at the financial markets, they did fantastic.
Looking at what moves should people make, I think I read a study that about 50% of people coming up to the election are going to switch their investments. If I were to switch my investments, how would I do it?
I think that the biggest key there would be, if you are going to switch your investments, do it in a measured way. Don't make wholesale changes. That's the biggest difference between institutions and individuals, right? Institutions have an asset allocation that they're targeting. Maybe it's 50-50 stocks, just to make that up, stocks and bonds. And if they want to make a change, they go to 46% stocks or 55% stocks. They do it in a measured way, and then if they're right, it helps. But if they're wrong, it doesn't destroy their future performance. Individuals all too often are prone to these wholesale shifts where it's, let me go from 50% stocks, I'm moving into cash, right? And then if the market takes off, they never catch up because it's like a train leaving the station. And the second is that psychologically, it's really hard once you're in cash to get back into the market either way, right? Because if what you feared comes to pass, you're afraid still. If the market's gone up, well, now it's too expensive.
That's great advice, because it's like, I'm super emotional about a certain candidate. Right, and it's if my candidate win, I want to go all in, right? So I'm either all in. If my candidate lose, I'm going to cash out and head for the hills, right? But if I'm a 60-40 investor, 60% stocks, 40% bonds, and I might just shift that, maybe go 65% stocks, 66% stocks, make small shifts. I think then I feel better because, hey, I'm taking advantage of this because my person's in, I can reap the rewards. But if the opposite happens, or if my person's in and the market blows up, I'm still not going to get killed either way.
Exactly, right? And it's great that people are passionate because that's what America was founded on, right? How lucky are we to be able to go out and vote and make our voices heard? And sometimes those voices are loud and people disagree, but that's the beauty of democracy. But the reality is that you need to focus not on the way you want things to be, but the way things are. And again, there's a lot of history that says that markets are going to do pretty well regardless. And then if you think about it and step back, that 60-40 investor probably has 5 or 10 years of spending set aside in short-term, high-quality fixed income, cash, something like that. By the time they're even worried about spending down their stocks, there's a new candidate in office anyway, or maybe a couple of elections have gone by.
Right, yeah, then there's another election, and that time is different, and then there's another election, and so on. Well, hey, I want to talk about your book a little bit more. Of course, we want to take in news to some degree and be knowledgeable, but for your investment decisions, I think the best thing to do is ignore a lot of the hype. Get his book, we're giving it away for free. That's a pretty good price, free.
Yeah, I mean, we're financial experts and we know that, right?
Yeah,
free is a good price.
So go to yourmoneyyourwealth.com, click on that special offer to get Brian Perry's book. Ignore the hype. Thank you, Brian. Really appreciate you joining us once again. We got to take another break. And then when we get back, we'll do some true false, we'll answer some questions, and then we'll wrap up the show. The show's called Your Money, Your Wealth. We'll be back in just a second. Hey, welcome back to the show. Show's called Your Money, Your Wealth. My name's Joe Anderson, and with Big Al Clopine, he's a CPA. I am a certified financial planner. Hey, you got to ignore the hype. We've been talking a lot of hype. You just got to ignore us. Read this book. Brian Perry wrote it. Chartered financial analyst, director of research, executive vice president, Pure Financial Advisors. Go to yourmoneyyourwealth.com. Click on that special offer. We'll send it out. Limited copies. We'll get it to you as soon as we can. So go to yourmoneyyourwealth.com. Get some good nuggets there. Before we wrap it up, let's see how you did on the true-false question.
If I sell a stock investment at a big loss, I generate a capital loss on my tax return, but I can't deduct that loss against a sale of my rental property. And the answer is false. You actually can. So anytime you have a capital loss, you can offset that loss dollar for dollar against any capital gain, whether it's from stock, real estate, whatever. Any kind of capital loss goes against any capital gain. So if you have a stock loss and you want to sell a rental property, you can net those two together. Joe, a lot of times people have, they get confused because they think they can only deduct a $3,000 loss, capital loss, which you can against ordinary income, but against another capital gain, it's dollar for dollar.
Yeah, without question, Al, tax planning is key. You know, sometimes with the stock and real estate, it's just a capital asset, basically. If you have a loss and you have a gain, you can offset it. But what I think in regards to taxes, what potentially could blow people up, especially if we see a lot of volatility in the overall markets over the next few months, is that people will believe they might have a loss, but the markets have been gangbusters, right? And so when the market drops, they're going to sell, and potentially, you know, they might end up with a large tax burden that they didn't necessarily know. Walk us through this, Al.
Yeah, I think that's exactly right. So here's an example of someone that bought a stock or mutual fund, let's say in 2010 for $25,000, and we've had a good bull run. So maybe at one of the market peaks, say February of 2020, it was $70,000. So you're thinking pretty good, right? Now we're coming up to election. There's going to be some volatility. The market goes down, it goes up, it goes down and up. But when it's down, you panic, you sell. Maybe you sell it at $55,000. You think you got a loss, but remember you bought it for $25,000. So you really have a $30,000 gain. And if you just take a 25% tax, capital gain, federal and state, depending upon the state you're in, that would be $7,500 in taxes. So you'd end up with about $47,000. So here you're sitting thinking, I got a $70,000 investment a couple months ago, and now you only end up with $47,000 in your pocket. We see this all over and over again, Joe, in terms of people selling when they really shouldn't be selling.
Right. I mean, and the history plays out is that if, let's say, if I'm a Republican, right, if a Republican wins, then I'm very bullish in the market. If a Democrat wins, I'm very bearish, so I'm going to sell. And vice versa. If I'm a Democrat and a Democrat wins, I'm very bullish in the overall markets. It's recency biased. It's all sorts of different biases that we have. And especially when it comes to our president, we get fairly emotional depending on who you're voting for. Be careful with that with your finances. You're thinking, oh my gosh, if this person gets in, I have to get out of the market, right? Well, you have to take a look at what the net result is. We've already been through the numbers. It doesn't necessarily matter if a Republican wins or a Democrat wins. On average, you're looking about the same. So if you're selling because someone gets into the office and then all of a sudden you have to pay all this tax and then you reinvest and you're trying to time it, be very careful with that. You're going to lose wealth potentially. Or if you think you're very bullish because someone gets into the office, you just want to make sure that you have a sound investment strategy. Since 1980 to now, just look at it, trends up. It doesn't matter if it's red or blue, it trends up. So make sure now that you have the right investment strategy and philosophy, given what your goals are. What are you trying to accomplish? Is it putting your kids through school? Is it retirement? Is it saving money in taxes? Whatever it is, make sure that you understand what you're doing with your overall money. The whole world and environment is a crazy place. We've known this for the last year. It will continue to be that way. You want to make sure that you're disciplined. Let's go to the audience. Let's get some questions, Al. Let's go to Ask the Experts.
I have 12 years before I retire. I'm concerned about my taxes going up after the election. Is now a good time to do some Roth conversions? This is from Patty in North Park. It probably is a good time to consider Roth conversions, not necessarily because of an election or anything like that, but tax rates are low. Tax rates are about as low as any time in my entire career, and I'm not a spring chicken anymore.
Spring chicken! I knew the spring chicken was coming.
Yeah, I think everyone should be thinking about Roth conversions right now just because tax rates are lower.
Yeah, I mean, you look at history of the tax code, I mean, relatively low. So does a conversion make sense for you? We have no idea, Patty. It depends on how much money that you have today, how much money that you'll have in the future, what your anticipation is going to be on tax rates, or let's say tax rates stay the same. Will you be in a lower tax bracket in retirement, or will you be in a higher tax bracket just because of the amount of income that you have today versus the future? So there's a lot more things involved of just saying, hey, I think tax rates are going to go up, should I do this strategy? You probably want to do a little bit more homework and a little bit more detail before you make a move like that, because you're going to end up paying taxes, and then that reduces wealth. Your strategy should be enhancing wealth, not necessarily just do a knee-jerk reaction. So what the heck did we learn today? Markets don't really care if it's red or blue. Market timing during an election year is a dangerous proposition, but I know, right, we want to do something. It's so hard for us not to do anything. You got to stick to a sound investment strategy. Hopefully you just have a good one, first of all, and make sure that you're true to that. And then because markets tend to reward investors that are patient, that are disciplined, and that are knowledgeable, that they understand what they're doing in the first place and they understand what they own. Once again, if you haven't got this book, you're missing out. Brian Perry's, right? Ignore the Hype. This is a really good time to ignore the hype. It's a great book. It's an easy read. It will make you a better investor, we hope. Go to yourmoneyyourwealth.com, yourmoneyyourwealth.com. Click on that special offer to get the book. We'll send it out to you for free. Look at that. We'll even pay for the packaging on this. That's a gift and a half. Hopefully you enjoyed the show. I know I did. Al, enjoy Hawaii. You'll probably be there for another few years.
It'll be a while. We'll keep doing shows from here. It's fun for me, Joe.
Oh yeah, it's great for me. I love it. It's so much nicer in the studio without you. So, all right, we'll see you again next week, folks. For Big Al Clopine, I'm Joe Anderson. You just watched another wonderful episode of Your Money, Your Wealth. We'll see you next week.